Welcome back to my channel, Balance Sheets Matter. I'm back from my little hiatus and back to doing stock analysis videos, and I thought that what's better to do than reanalyze some of the stocks I had previously done since it's been about 2 years. This gives us a chance to look at the previous stock analysis, see if they were accurate, if they're on point, if they gave some good insights, and then also relook how the stock has changed and provide some new analysis basically going forward. So I've already done one of these videos analyzing JM Smuckers, Charter Communications, and Starbucks. So now we're going to continue in the order, and we're going to look at Home Depot, UPS, and Verisign. And it's been about 2 years since I had looked at any of those previous stocks, so this is a good time to reanalyze them and update them. So let's look at Home Depot. So the previous big thing I had said about Home Depot before is, in my summary, we're not going to go over every little financial detail. We're just going to see if there's really the updates going, is that before they were operating at a very high EPS growth of about 16%, and they had a compound annual growth rate in the stock at 20. Let's bring up Home Depot here, and you can see before, which I did mention in my video, this is the previous trend they were going at, and for a variety of reasons, I felt that they would not continue this compounding growth rate, and they would probably more likely break the trend and start entering a sideways trend, which has started happening. And as we can see, after they did their acquisition, the revenue did have a nice little bit of a larger jump and continues to jump up. Their gross margins has maintained. So this is a good sign. The one thing I did mention before, which is a little bit of a downside, is before their operating margin, they had grown it in the past and it was stabilized. And we were hoping it was going to stay stabilized, but it has actually contracted a little bit. And this is a little bit unfortunate, since typically when you do an acquisition, you want to get some synergies and be able to reduce your overall overhead that should, technically increase your operating margin. And right now, since the acquisition, we've actually had 2 years now of ticking down in the operating margin. So this is something I would be watching a little bit. I'm not super worried about it because they're maintaining the gross margins quite high, but we should start seeing if they do get any synergies from the acquisition they did get before, and they start announcing that they're going to be reducing the headcount a little bit to bring those selling and general admin expenses down. Also, with the debt they've taken, they have increased their debt interest expense quite a bit from the acquisition, and it's now falling out of this usual ratio I like. As you can see, the operating income was just under $21 billion, and since when I did the video, it's actually gone down a little bit, but that's because of the operating margins that I just mentioned, and their interest expense has gone up. So these are not the best progressions basically for the stock. And one of the previous drivers I'd mentioned that was driving their high compound annual growth rate and the 16% EPS growth rate was initially back here as the operating margin growth. And right now it's actually contracting a little bit. So this is going to be hurting their EPS. And probably the best they're going to be looking at going in the future is maybe trying to get it back to this 14 or 15% level. The other thing, which was a driver before of the EPS growth, was the tax rate. And as I previously mentioned, after their operating margin expansion ended, then there was the tax cuts, which basically helped them, drive that EPS as well. And now taxes aren't going lower. That cylinder is no longer a tailwind either. And then as we can see on their net income here, it's been, almost actually like going down or, flat over the last few years. It is down actually since when I originally did the video there, and you can see the net margin now is down to about 8.6%. This is not abnormal. They've had years that were definitely lower than that, and they've had years that were a little bit higher, but we can kind of see probably around that 10% is more at the higher end of the net margins they will be going in the future. And then the third driver that I had mentioned as well for the EPS growth was the share buybacks. And you can see since I last did the video, they had just, I think this is 1 billion, 2 million shares, and they barely reduced that at all. They're not really doing much share buybacks anymore. So as you can see, the three pillars that had driven this really tremendous growth basically in the past have all evaporated, and it does not look like those are going to continue going forward. So on their balance sheet, the one thing to notice is because they did the acquisition, there is now a lot of goodwill on their balance sheet. And if we look at their total equity, it's 12 billion there with $22 billion of goodwill. That does give us negative equity. So when looking at it that way, so that's, not the greatest. Basically, they haven't improved their balance sheet over this time. And then when we look into cash flow, I'm just going to point out a few notable things. Is before we had noticed that there was a little tick down in the stock-based compensation, but actually, well, I think it had a tick down as a different stock to tick down, but it's actually increased quite a bit for the stock-based compensation. So now that they're doing more stock-based compensation, they do need to try to offset this by buying back some shares. And other than that, the cash flow from depreciation and the purchase of plant, property, equipment, that's still pretty standard. And you can see they have basically stopped the repurchase of stock, and this was what they announced and was expected from the acquisition they did. And the one unfortunate thing we can see here is we would want to see them starting to pay back some of this debt, but we are actually not seeing that right now. We're actually seeing still continue net issuance of debt. So that's why their interest expense basically is going up. It's a little bit higher. So we're really likely not going to see any significant share repurchases going forward in the near-term future, especially when they're effectively taking out, debt and not buying it, and their interest expense is going up. It does look like they did do another acquisition basically back here in the last, few months. And, that is one of the things they are trying to do because the company has been slowing down to drive their growth. But the problem we saw with the last one, as I mentioned previously, is we really didn't see any synergies in reducing the operating margin of being able to, use the staff, overall run both businesses. So this is one thing we're going to want to look for going forward, if they can actually get some of the synergies and get their operating margin back up. So, and you can see their free cash flow there. So let's go into the interactive chart here, look at what the projections are. We can see we pop up the revenue trend. They are expecting to grow, but going forward. But when you're looking at this, they're 171 billion, and they're only expecting to grow, like what's that, $7 billion. So this is quite minimal growth, quite slow now, and we'll bring up the EPS estimate, which I think the problem is that from what they're showing here is the analysts seem actually like there's going to be this very big reacceleration in the EPS growth. But I think from the analysis we did and what we've seen in the stock, there are no fundamental drivers behind where they're going to be able to increase that EPS at this rate, which is being projected, unless they're able to really get some of those synergies and get that selling and general admin down, which does not seem to be happening for their last acquisition. It's actually gone up and made their operating margins lower. I would not expect the EPS to continue basically up at this rate. And we go into a little bit of the valuation. Let's bring the price to sales up. And I originally said that it was, because of the slowdown in growth, and now we're also seeing the compressions in the margins there, these previous low price to sales ratios here would kind of be maybe our targets to look at potentially buying the stock. And a lot of what the stock has done, it's basically dropped sideways. And I think even now we could probably set our sights a little bit lower. Let's just get one of these lines here and just look at some of these previous levels down here of that. We don't need that. We could see the price to sales ratio before I may be interested in the stock getting a little bit into these lower levels here. Now let's bring up the PE ratio, get a little bit of feel for what that is looking like as well. And again, when it was at these little bit lower levels, that's when it was a little bit more attractive. We're sitting at a little bit higher PE. We really don't have any good EPS drivers right now. And you can see in the past here also, it was during the great financial crisis, 2008, 2007, this did get down to around a 10 PE ratio. And right now we're sitting at a 23. Before, when the company was looking actually a little bit better shape, in my opinion, it was still trading at a mid-teens. So there's definitely some reason why we could garner a lower PE ratio, maybe in these levels about down here. Well, that's gonna mess up my chart there, but that's fine. So we go into the chart here, and you can see, as I said, I was expecting this trend to break because I didn't see any way they were going to continue with this growth rate, which they haven't. And I did mark these two different levels here. And I said I would really only be looking at potentially buying the stock if they ever got back down to this more to 70 level here. But if you want to play for a short-term trade, you could play it off this 330 level support here. And I think when I did the analysis was back somewhere here, and as you can see, it actually has served this level, has served this support several times and bounced around. So I preferably just didn't trade it off those levels because I didn't want to buy it at what I feel is not the greatest price, and just hoping basically for a little short-term bounce, which has been short-lived every time, and kind of wait for it to get down to the level here, reanalyze and see if it's worth it. And if you look at the longer-term history, you can kind of see this is how Home Depot's done things is the stock gets like the big markup, and they kind of go into a consolidation pattern for a while, breaking that trend. A markup, a consolidation pattern, a markup, a consolidation pattern. So they've got the markup now. This old trend is over. And at this point now, I really would want to be seeing Home Depot at a lower P ratio, and that's when I'll be interested. I still do think it's a high quality company overall, but we did see a little bit of pressures going on. And because of having to drive yourself through acquisitions, they got to take debt to do that. They have a lot of debt right now, high interest expense. They have to pay that down. That's going to basically hurt their share buybacks. So I just don't really see any positive catalysts to really boost the Home Depot price going forward in the future. So I don't have any short-term expectations to buy this, although I would kind of maybe reanalyze, see what they are here, but I would honestly be really looking at a Home Depot getting to potentially a 15 PE or lower. And based on this trend they're forming here, let me just see if I can grab my brush. There we go. It might digest the price just by going sideways for a while before it sufficiently works that off. Maybe by several years down the future, it'll be again maybe just around this 300 range, but at that point it's going to be under a 15p ratio. So overall, I think my previous analysis on Home Depot, I was fairly spot on about a lot of the things going forward. We haven't seen that reacceleration with growth. The levels I've given have been relatively accurate, and I still kind of stick to that. So if you do want to see the full analysis I did, you should watch the previous video. But we are going to go on to the next stock now. And the next stock was UPS. So UPS here, when I originally did this video, a little bit over 2 years ago, let's bring up the chart here. I had done it about right here when I was around $150, and I thought the stock was too expensive, and said basically at the 120 level is when I would start getting interested in because of this kind of consolidation zone here. And as you can see, it did stick around there for a little bit, and it has fallen in the zone there. But the real question is that actually a good value going forward? So we'll bring up UPS here, and you do see the PE is relatively attractive 15 P ratio now, and the dividend yield is looking very high at 6.46%, but has a very, very high payout ratio, which we are going to get into. So as we go down in UPS here, the issue before is they were starting to contract on the revenue a little bit. A lot of this was because of Amazon pulling back a little bit, and there's even just looking up some recent articles, they are still continuing actually to plan some more pullbacks in the future, even though they are expecting some positive growth going forward. So, well, the revenue trend has been declining. This is not necessarily because they're losing their moat or it's a declining business. They have one, partner, Amazon, who's saying, hey, we want to do more shipping ourselves. We don't need you anymore. And as long as they're basically pulling back, that is going to create, temporary pullbacks in the revenue and a plateau. And once that stops and they can resume the normal trend, because shipping rates do go up over time, that should, probably continue. And their gross margin, 18%. I think this is just fine. This is pretty much in the historical norm. It's not as high as it's been on the high side, but it's definitely not as low on the low side. So they have maintained that. I've said before, I do have my own e-commerce business, and I use UPS a lot. I do think they actually provide some of the better rates out of all the carriers there. And as inflation goes forward, people raise the rates, and I think these margins are going to be fairly steady going forward. The one unfortunate thing though is where they have had this kind of overall structural decline here from Amazon pulling back. It is not being reflected in their other operating expenses, as these actually with inflation have ticked up a little bit, and that squeezed their operating margin a little bit. So we're probably not going to see this operating margin actually increase again until they start getting the re-acceleration in revenue. And, is this 8-9% really something we should be too worried about? If we look at the past, we can see they kind of, they cycle like this. UPS does have a big union. It's not super easy necessarily to lay off people all the time, or if they do lay off people, they sometimes, have to, do some, payouts for it. So that is one of the short-term pressures there. I do not think this is a systemic problem. Every time they've had their operating margin get lower, you can see they have been able to basically get things solved by, either keeping it the same and raising effectively, the revenue going forward from the expenses there. And it's like, let's just look at one of the things. So you can see, like in 2020, other operating expenses here, 7.6 billion. They did lower it a little bit as the revenue increased. So I think they will solve this in the future. Exactly when, since Amazon's still planning on doing some cutting back in 2026 right now, well, we may not start seeing that till actually like next year. And also their interest expense has gone up a little bit. In this economy, well, it's like the stock market, the S&P 500 has been going up. That's largely because of just big tech and, the AI effectively bailed out, where a lot of these just like, normal stocks have really all still been having a lot of headwinds and struggling a little bit since, 2020 and what happened there. So their, interest expense is a little bit higher. It's getting a little bit out of this ratio that I usually like. I like to say like there's a 1 to 10. So it's a little bit worse, not too disastrous or anything. And on the bottom line here, 6% margin. This is, not out of the norm. It's, sticks to what we were saying, basically before with the other margins there. And the shares outstanding, they've really not reduced it very much. And I'll get into that in a second of why that is. But we did mention before the very high dividend. And I think that is going to be kind of a problematic thing. That they won't be able to buy back the shares, when this is probably a time they should be buying back the shares, but companies don't like to cut their dividends. So I don't think there was any huge changes on their balance sheet here. So let's just kind of skip that. Yeah, you can see full equity is basically the same, nothing remarkable changing there. The one interesting thing is they did slash back their stock-based compensation a lot. And well, that's kind of good that, okay, we're not going to be issuing stock at potentially these like, low prices diluting the company, because if they're not able to do as many buybacks, well, you can't, offset it with the share buybacks. They do actually don't have as much, cash flow now. And instead of paying people in stock-based compensation, they do have to actually pay them in real money. And anyways, the purchase of plant, property, and equipment here, the trend has actually gone down a little bit. Will this maintain? It's hard to exactly say, but it has got more line replacements. So whatever they are kind of showing on their top line for their net income, I think is going to be going forward a very accurate reflection of really what the free cash flow is and what they can effectively afford. So anyways, they do these like little acquisitions. As you can see, it's been along the way. Nothing too remarkable, but that's the business they are in. And they did do kind of some minimal share repurchases. They also have, issuance of stock at the same time, and between balancing everything out, it really hasn't, budged too much. And if we see, though, there has been net issuance of debt. They actually have issued, where they did have a little payback here. They still kind of are in this thing where they are issuing more debt to basically support some repurchase of stock which is just offsetting at this point. And also they have this really, really high dividend. It's more or less maintained the same. I didn't think they were going to basically want to. They're not going to be able to increase it. And I looked up earlier and their CEO says, oh yeah, we have no plans on increasing it. But also they don't want to cut it. And the problem is they don't want to cut it. And you look at their free cash flow, they really can't necessarily afford it every year, especially with the stock-based compensation. So this is kind of an unfortunate thing, is they had raised it too earlier before when they had the big boom from the Amazon contracts and with all the shipping there. And now that those are kind of gone, they're like, hey, we're going to maintain our dividend, but we really can't afford it comfortably. Yes, they can afford it, but they are taking out a little bit of debt to do this. And I think I did mention that they would likely actually start taking out debt in my last video to pay their dividend, because they really don't like doing that. So I think they are just going to continue doing this trend, which is not super preferable since this is actually when you would want them to buy back shares in the short term. And they're just going to basically hope that their revenue grows, their earnings grow, and their free cash flow gets up. And if things do improve going forward for them and they stop having this headwind of Amazon cut back, that should happen. But if things were to get kind of unknown deterioration, they might actually have to cut their dividend, which, they probably should have done that before when the stock price was higher because it dropped anyways. And, anyways, now they're, they are where they are. So that is, I kind of did have some, I think accurate insights of what they would do there. And, going forward, we're going to, see how that is. I'm not the happiest about, that's where it is, but, it really depends about the valuation because as I've said in all my other videos, management, they typically, for the dividends, they don't want to cut them when they probably should cut them. And they always do share buybacks too high rather than low. And that's just like something that every company seems to do. So we can see the revenue trend. It didn't increase right away. It's, kind of plateaued, gone down. They're expecting a little uptick here. It's hard to say if that's going to happen. But once this Amazon headwind of them, Amazon cutting back using UPS basically does die down, we should start seeing them resume this trend again. But is that going to happen this year? I'm not so sure. So let's bring up the EPS with estimate. And again, yeah, the EPS, has been dropping for the reasons we explained. And if the Amazon issue and they do stop getting the, cutbacks there, they should be able to get some increase in going again. So that doesn't really tell us anything new, but let's pop up the price to sales ratio, which before I was saying that it's like, it's kind of a mid price. It's a little bit, not that attractive. And where we are sitting right now for a price to sales ratio, you compare this to the past. Let's just, the line there, where these, previous lows were from to 2009 there. And we are at a comparable price to sales ratio now because this is getting, in my opinion, a lot more deeper value zone here. Also bring up the price to earnings ratio. And if we get rid of these little pop-ups here, it's trading at a 15, and this has been generally in their lower range. They sometimes, this was when it was a little bit artificially high, and you kind of have to be able to spot those things to ignore it. But like typically around this area here, they were trading around a 15 to a 20, and even back here, 15 typically has been on a little bit the lower side. Let's just look a little bit further back, and it's been, fairly consistent about that. So I am seeing that the stock is on a much better value than it was before. And the one thing I want to bring up is the dividend yield, because, a lot of dividend investors, they get, very attractive on the dividend. One thing I mentioned before is that, even though the dividend yield, when I originally did the analysis, which was somewhere around here, looked relatively high because the payout ratio was so high, I thought, well, this actually isn't, a relatively high dividend yield, and it's very likely that, they're going to try to maintain the payouts and the dividend yield's going to go higher, and that's what they've done. And you just got to realize here that if there is some real headwinds for UPS going forward, they would need to cut this dividend. So it's not necessarily that safe, in my opinion. So anyways, we'll go to the chart here. I originally basically started getting interested, bought a little at 120, and then, you had basically a very big drop, but then, really got a chance to accumulate in here, get a low average in the low, 100s. Obviously, could have, you bought it right at, 85, you'd be, pretty happy. And this, I think, is generally met kind of what I, expected it to do. It had a little bit rosier outlook before, and this upper area was the first kind of interest point and support. But really anywhere in this band, and because of the further kind of pulling back from Amazon and everything, it did end up going to the much lower range. But I think it has been finding a lot of support here. And you can even see from the volume here is that this is definitely higher volume than before. And this has all been in this basically price range here. And, what happened basically when it was a previous really good price in 2008, 2009? Well, you had a big increase in volume there when the prices were around like that. So going forward, it's, again, you can have little headwinds. Is it going to break the lows here? I'm not really seeing anything that it's going to break the lows But it could chop around a little bit sideways before taking off. But if things start kind of normalizing, they get a chance to start increasing the revenue again because Amazon's not pulling. There's no more contracts to pull back from Amazon. I would basically expect this to revert back to the main trend, which is effectively was always the thesis around UPS. So overall, it's I think it was a reasonable analysis I did on UPS, nailed a few things correctly. Although it's one of these things you do have to go and you have to reanalyze as it's going forward because the EPS estimates were a lot higher before and they did get lowered as Amazon continued basically to pull back services, and that's one of the reasons why UPS maybe went to this little bit lower range versus supporting a little bit higher. But overall, I think it's the stocks doesn't have any risk of bankruptcy, and I'm not seeing any major deterioration. And in my opinion, I have a position, and I don't know if I'm going to build it anymore. It's around this level here. Just going to kind of let it go up, and hopefully, what's going to happen is over time, it's going to revert to this mean trend in the middle here, which is probably around fair value when they normalize their business. And that's 70% upside from here. And depending on your goals and this and that, if you just want a stable stock, you can let it ride, or you can sell it into some strength. That really depends on what the investor likes to do. So the last stock is Verisign, and they basically do the domain registry for .coms and various other extensions. And there's very little to go on with the financials. This has a effectively a world government enabled monopoly, and well, everything just stays the same. They continue to just keep getting better. The gross margins were already high. They've gone marginally up. Operating margins have also gone, marginally up as well. There's nothing significant in in their financial statements. Everything's just continued to go up. They have a 60% margin, and there's really all it came down to. I was saying before is you just need to find a good price to buy this stock. And let's bring up the chart here. When I originally did it, I marked this around this 178 level as for a few reasons. For valuation reason, there's a gap here, good technical support, and as you can see, what's happened since, it actually has done very well. And in my previous video, I'd say in 2026, we probably could be looking at fair value around $260, and it's well, we're at $260 right now. So I'll kind of get into a little bit of the reasoning behind that, and a lot of it's just you can just look at the P ratio here. Go on a little bit shorter time frame. Oh, let's just swap into 10 years here, and they get on the high side of 40, and really when the buy is when they get into the mid low 20s, and when it was in this 170 180 price range, this was really signaling, like I said before, it was a really good buy because this is a really low 20s PE. They normally can get up the 40. Here they had a little peak in the mid 30s. Not always guaranteed to get up to 40, and their kind of fair value would be 30, which is actually where they are now. So if you are interested in Verisign, I really don't see the attractiveness as buying it at a 30 PE because that's kind of a fair value. I really, for one of these, would want a 25 and below because nothing's really disrupted them up till now. I wouldn't see that going forward. And this is one of these you buy it at a good valuation. You can hold it forever if you want, or you can kind of sell it into some strength. So I'm still holding it right now, but possibly just kind of seeing how they're starting to make this trend. And the interesting thing is I had my little channel. This is the trend channel here they have, and they reverted right to the middle of it. And I think this is a very possible thing that in kind of a action like this, they're going to stay in this trend. And if they are going to actually go higher, it's not going to be immediately straight up overnight. They're going to probably start, having to show oh, we're going to overshoot there and start, building up like that. But my personal strategy with Verisign right now is, because I did get around, that 178, 180, is I kind of want to, if they get to this top channel here again, that's going to be, I think, they're going to be pushing a higher 30s PE, 35 plus. And I think that's going to be a point where I would, take some profits. And then if I, do get that opportunity, basically sell here, and then they come back down in the future, if I can buy them down at this level again, well, at that point, it would probably be about a 25 PE. And I think that would be a good point to re-enter. this is one of those stocks that, you just wait for the good valuation, and that's what you do going forward. Nothing's really changed with the company, and I think my analysis for them was pretty spot on. It's kind of everything's worked out as expected, and they're going to produce hopefully some good returns going forward. And if you can sell at a favorable time, you can from here you're effectively doubling your money, and then you can re-enter. You can potentially make a lot of money playing these swings, or just kind of ride this overall trend, which I think is about 12%, and make the money long term like that. And if you bought it at a discount, well, you get that additional markup in between for a long term buy, and that's what it is. So, anyways, it's overall, I think that's a good update for those three different stocks. I think originally what I said has somewhat stuck. UPS, it did go a little bit lower than I was initially expecting, but if you did look at the financials around that, and you kind of do have to keep up to date. Just because I say, oh, there's something now, I am telling you that there's things you have to watch out for, and these things, they can change your positions. Because something like in my last video I did on Starbucks there, I thought it was a good buy, but if you see this deterioration, well, I'm not going to like the stock anymore, and that's what happened. I sold it for at least a small profit, and there's other stocks that I've done that well, and it was like, well, with UPS, basically, they had a little bit of a decline in revenue when they were expecting an incline in revenue, and also there was a little bit more pinch on the margin, so that does basically was a justification for them pushing down a little bit to the lower side. Although that actually, if you were patient, just don't buy it all at 120. That did give you some really good opportunities to potentially buy it under $100. Since I'm going to say that I do think that's a good value going forward. So, anyways, UPS basically, and if that was really actually a good analysis, well, we're going to have to wait for it to go forward. Since at the time I said 150 was too expensive. That was accurate. Now I think very good valuation, around $100, a little under, even a little over. We'll see if that plays out well. Verisign pretty much exactly as expected. At Home Depot, I wasn't recommending buying the stock, but kind of what I expected to happen has basically happened. And if you want to play it off those levels, that's basically up to you. I wasn't interested in that, but I may give an update on it if it does get to the 270s, and give an update that, oh, do I actually think it's going to be a good valuation here? The problem is sometimes when it comes down to these levels and it'll cut through them, it's because of a really bad event that's going to mark it down lower. So you kind of have to wait for things to happen before just blindly buying at the different levels, such as UPS a little bit, for example, after the gap down here. I won't take too much longer on this video, but after here, and you had the gap down, you kind of have to reevaluate the stock a little bit and say, okay, if I bought some here, I bought my starter, but I'm not necessarily at this point, from this gap down here and breaking the support here, I'm not going to necessarily just rush into it. Wait for the dust to settle. And even if you didn't wait for the 80s here, but you got in around 100, that was not necessarily a bad price. Yeah, you've effectively gone sideways, but have collected a few dollars in dividends. I think it's $1.64 for dividends, so that's a little, like, I think over $6 total you would have collected in this time there, and that's not too bad. And anyways, if it continues to increase, that would be pretty good. So anyways, I hope you enjoyed these updates. If you do want to see what I was previously saying, you can look back at them and give me your thoughts, and I'll see you in the next stock analysis video.